Hey guys, today we're going to be watching a little piece from the 1996 Berkshire Hathaway conference from Warren Buffett. He'll be answering the question, should you wait for a market crash to buy stocks? So in this video, I'm going to show you the video and give a bit of commentary on what my thoughts are. So hope you enjoy it. Let's get into it.
Well, I won't comment on the three companies that you've named, but in general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company.
Warren Buffett emphasizes that if you've identified a truly great company, one you believe will remain successful for decades to come, the current price should not be a major deterrent unless it's outrageously high. A great company is one with a durable competitive advantage, excellent management, and a proven track record of consistent growth. These companies don't become great by accident. They're the kinds of businesses that stand the test of time and continue to thrive, even when the economy or the market takes a hit. Buffett's key message here is that waiting for a better price or a market crash to buy these companies is often unnecessary. If the company is as exceptional as you believe, its value will grow over time, making the price you pay today much less important in the long run. Let's be honest, how often do you see people waiting for companies like Apple to go on clearance? Never happens, right? It's the same thing with stocks and with investing. Don't let the price tag scare you away from quality.
So you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them.
Buffett uses a vivid analogy here to emphasize the importance of investing in companies with long-term resilience and stability. If, for example, you left your stocks alone for 20 years without buying or selling, do you think the company will be stronger than it is today? This means looking for companies with strong fundamentals, consistent earnings growth, a durable competitive advantage, as we mentioned before, exceptional management, and a product or service that people will continue to need or want for decades. One of his biggest investments is Apple, carrying on our example from before, and over the past couple decades, they've dominated the consumer electronics business, and they've only become larger and more powerful. These are businesses that can weather market volatility, industry changes, and even economic recessions.
We could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. We found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I'm not sure that will be a great technique. It may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. He didn't inherit it exactly. He talked his mother out of it, but yeah. It's true, actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on. And
Buffett highlights just how rare great companies are. Finding them is already a significant challenge. Waiting for them to become cheap during market panics or downturns or recessions, that kind of thing, is even harder and often impractical. The idea of timing the market perfectly, whether during a crash or a panic, is not a realistic or sustainable investment strategy. He's essentially saying, don't overcomplicate it. Waiting for a perfect moment, like a market crash, to swoop in and buy great companies at a bargain is risky and usually ends up with you doing nothing. For example, a year ago, nobody was saying that the S&P 500 was going to grow like we've seen. We don't know what's going to happen. Even the market commentators a year ago were wrong. You might have heard this saying before, time in the market, not timing the market. That's basically what Warren Buffett here is advocating for.
If you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets, you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it, and you'll probably learn a lot more with him by coming to this meeting.
Buffett stresses that attempting to predict the exact bottom of the market is foolish and near impossible. So he's continuing on from what he was saying earlier. Market prices fluctuate unpredictably, and trying to wait for the perfect low often results in missed opportunities. Even if you succeed in timing one bottom, there is no guarantee you'll be able to repeat it so consistently. Instead, he advises focusing on the long-term value of investments. For beginner investors, this means the smartest approach is to consistently invest over time, regardless of the market conditions. By doing this, you're taking advantage of a strategy called dollar cost averaging, where you smooth out the ups and downs and build your portfolio steadily.
But it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, look, my brother just died and he owned 20% of the business, and I want somebody to go in with me to buy that 20%, and the price looks a little high maybe, but this is what I think I can get for it. Do you want to buy in? I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. And it won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some added money at some time when something dramatic has happened, I mean, we did well back in 1964 because American Express ran into a crook. We did well in 1976 because Geico's managers and auditors didn't know what the loss reserve should have been the previous couple of years. So
Buffett urges investors to think of stocks as ownership in real businesses, rather than just prices on a screen. Prices on a screen is a bit like gambling, whereas if you understand stocks as a representation of a real business, you might look at the business instead and then make your judgment call. As he said, if companies were only quoted once a year, investing would be a lot more intelligent. Without constant noise of whether a company saw its stock price rise or fall each day, the investment decision would solely rely on understanding the company itself. Things like its strength, its potential to grow, and ability to generate profits over the long term. It's like getting to know someone outside of social media. Instead of focusing on likes and followers, you instead get to know someone, or in this case, a company.
So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.
To round out the video, he's basically saying to not wait around for Boxing Day sales, when you could have bought everything months prior without the stress. So if you're looking to start investing, there is no time like the present to find some gems. It doesn't matter what time of the year it is, there's always a hidden opportunity in the market. It's just about finding it. If we fast forward 5 years, we'll look back on this time and think, that company was really cheap. I know I certainly do with the likes of Tesla and Nvidia. If I'd found those gems all the way back 5 years ago, I'd be a lot richer than what I am now. If you want to see more videos from Buffett with my commentary, make sure to check out these links, which should be appearing somewhere over here. Thanks for watching, don't forget to subscribe, and I look forward to catching you on the next one. Cheers.